Investing in private equity real estate firms is how many of the top 1% of investors in America make their money. In other words, this is the top of the food chain when it comes to real estate investing. There are two other ways of investing in real estate, but institutional-level private equity firms provide you with the highest quality and most lucrative deals. The first and most common method of real estate investing is direct investments. Under this method, you're fully responsible for selecting, underwriting, financing, and managing your property assets. If you're new to the market, you may have a difficult time adjusting without the support of multiple advisors. The second method involves purchasing shares in a publicly listed real estate company. When investors take this route, they usually invest in shares from a real estate investment trust or operating company. The problem here is that these are often subject to the volatile fluctuations of the stock market. And finally, you can invest with an institutional-level private equity real estate firm, also known as a general partner or sponsor. This method offers passive investment in a specified or discretionary fund with an abundance of sector, strategy, and diversification options. This is why private equity real estate firms are the clear choice for lucrative investment opportunities. So what exactly is an institutional-level private equity real estate company, and how does it work? Private equity real estate companies raise capital to acquire, manage, and sell properties to generate returns for their investors. Typically, they form funds with different strategies that appeal to high-net-worth individuals, institutional, and family office investors. The GP typically invests their own funds alongside their investors, generally contributing up to 10% to each fund, with other investors, usually limited partners or LPs, who provide the additional 90%. LPs invest with private equity companies to get access to the best deals, leverage the GP's capabilities, receive limited liability, and earn preferred returns. Once funded, a private equity real estate company acquires the properties that meet the acquisition criteria of the fund. Typically, the GP is responsible for the operational aspects of the fund, while the LP investors are passive and enjoy the benefit of limited liability and preferred returns. Now that we know what a private equity real estate company does and how they work, let's explore how they make money. Generally speaking, these companies have three main sources of revenue. The first stream of revenue comes from the returns gained from their fund investments alongside other LP investors. The second source comes from any fees applied for the array of services they provide for the fund, including but not limited to acquisition, financing, and management of the asset, dispositions, and construction management. Finally, they earn a disproportionate share of the profits as a performance incentive fee known as a promoted interest. This is usually earned after all investors receive a certain preferred rate of return, for example, 8%. After each investor receives that 8%, the private equity real estate firm starts to earn a growing percentage of the cash flow and profits from the investment. This technique has led to many of today's largest fortunes. Stay tuned for our next video, GP Stake Investing, which will talk about how you can invest in private equity real estate companies. To learn more about Essential Realty Partners and our private equity real estate company, please email our CEO, Rick Courtney, at rc@erpartners.us.